Gold is already above 5,000. Silver is sprinting. Oil is twitching like a live wire. And the Iran-America pressure gauge just climbed into a zone where markets stopped behaving normally. That is what happened. Not maybe, not sometime soon. Right now, the world is pricing a conflict risk that most people still think is just noise in the background. But the money doesn't treat it like noise. The money treats it like a fuse. And once a fuse is lit, you don't get to vote on how fast it burns. Welcome back. In the next few minutes, I'm going to show you what's actually pushing gold and silver, why this setup is different from the last 50 years, and the one chain reaction almost nobody connects until it's too late. Stay with me, because this isn't just about a chart. It's about what happens to your purchasing power when geopolitics collides with debt, inflation, and the energy system at the same time. Here's the uncomfortable truth. Every generation gets one money moment. The kind of moment where your brain keeps living in the old rules, but the market starts trading the new rules. For some people it was 1979, for others it was 2008, for others it was 2022. And now it might be 2026. Because when the Middle East heats up, the world doesn't just get nervous. The world gets expensive, fast. You've seen the pattern before, even if nobody framed it for you. A major conflict flares in the region. Oil supply risk jumps. Inflation expectations jump. And then gold and silver do what they have done for centuries. They act like an escape hatch. That's not ideology. It's human behavior with a ticker symbol. Go back to 1979. A stable order collapsed almost overnight. Oil flow became uncertain. Inflation surged across the West, and gold didn't politely drift higher. It launched. From roughly 200 an ounce to over 800 within about a year. That wasn't a slow bull market. That was the market screaming. Then look at 1990. Iraq goes into Kuwait. The Gulf region becomes a headline every hour. Oil spikes hard. Gold reacts immediately. Even after the fighting ended, the financial aftershocks kept echoing because the fear had already rewired positioning. Then 2003, another major war. Gold was already moving, but conflict poured gasoline on the move. In the years that followed, gold didn't just rise. It repriced an entire era of monetary confidence, from the low hundreds to four figures. Then 2022. A major invasion in Europe. Gold touched 2,000 quickly because the market doesn't wait for academic certainty. It waits for risk managers to panic. Now look at today's starting point. We're not starting at 200 or 300 or even 2,000. We're starting above 5,000. That matters, because percentage moves on a higher base can create absolute moves that feel unreal. A move that would have been a few $100s in the past can become a few $1,000s now. History doesn't just repeat, it repeats with leverage. But let's address the pushback. People always say, markets calm down after the initial shock. Sometimes they do. But this time the market is dealing with three conditions that did not exist together in those previous eras. Three conditions that make calm down a lot harder. First, the dollar is not the same safe haven it used to be. In older crises, investors ran to the dollar and gold at the same time. The dollar was strong, America's balance sheet looked more credible, and the world treated U.S. debt like a pristine asset. Today you have a different picture. A national debt above $36 trillion. Years of inflation that already trained people to distrust cash. A public that feels price pressure every week. So when fear rises now, a chunk of money skips the dollar step and runs straight into hard assets. That's a big change. Second, central banks are not sitting on the sidelines. For the last couple of years, central banks have been buying gold at the fastest pace in roughly half a century. China, India, Russia, Poland, Turkey, and others have been accumulating quietly, steadily, strategically. That buying does something important. It puts a floor under the market that didn't exist when central banks were sellers or neutral. It reduces the amount of gold available at the margins when panic hits. It stiffens the market. And when a market stiffens, price moves get violent. Third, silver is not just an investor metal anymore. It's an industrial necessity. Solar panels consume silver. Electric vehicles consume silver. The global push toward cleaner energy is not a slogan. It is a supply chain that physically requires metals. Silver is being pulled by two forces at once: fear demand and factory demand. Gold mostly reacts to fear, real rates, currency confidence, and central bank activity. Silver reacts to all of that, plus manufacturing. That's why silver can look boring for years, And then, during the right setup, it becomes a slingshot. Now let's talk about the part many channels avoid because it feels too heavy for a market video. The nuclear dimension. Here's what you need to understand. The market doesn't need a nuclear weapon to be used to price nuclear fear. It only needs the perception that the world is approaching a threshold where deterrence, miscalculation, and existential language enter the conversation. Reports of uranium enrichment moving closer to weapons-grade territory changes the entire psychology of decision-makers. International inspectors raising alarms changes it. Public statements from governments that a nuclear-armed Iran is not acceptable changes it. That combination doesn't guarantee a war, but it increases the probability of an action that markets cannot model cleanly. And when markets can't model something, they pay up for insurance. Gold is insurance. Silver becomes leveraged insurance. This is why in a high-stakes escalation scenario, gold can move hundreds of dollars in one session, and silver can move $10, $15, $20 in a day. Not because the universe broke, because positioning breaks. Risk managers don't debate philosophy. They hit the button. Now we need to connect this to the mechanism that actually drives price, the chain reaction. If you understand this chain reaction, you stop being confused by the day-to-day volatility. You stop watching the chart like it's a magic 8-ball. You start watching the dominoes. Domino 1. Disruption risk in the Strait of Hormuz. That narrow corridor is not a trivia fact. It is a choke point that sits under a massive chunk of global oil flow. If the market believes it could be disrupted, even temporarily, energy traders don't wait for confirmation. They bid. Domino 2. Oil spikes. Some analysts talk about 150 per barrel or higher in an aggressive escalation scenario. The exact number is not the point. The point is the speed. Oil doesn't need to stay high for a year to change inflation expectations. It only needs to spike hard enough to shock the system. Domino 3. Inflation shock. Oil is a tax on everything. Transportation costs jump. Shipping costs jump. Manufacturing costs jump. Food costs jump. Every supply chain feels it because energy touches every step. Now the consumer feels it. The business owner feels it. The government feels it. Domino 4. The purchasing power panic. When inflation rises, cash becomes a melting ice cube. People don't need a finance degree to understand that. They just need a grocery bill that won't stop climbing. At that point, behavior changes. People start converting money into things that feel real. Real estate, commodities, gold, silver, anything that can't be printed. Domino 5. Metals absorb the flow. Gold gets the first wave because it's the global language of fear. Silver often gets the second wave, and then the third wave because once gold headlines hit, people look for the cheaper metal with more upside. Domino 6. The attention loop. As price rises, media coverage increases. As coverage increases, retail money shows up. As retail shows up, momentum traders show up. And suddenly the move isn't just fundamentals. It becomes reflexive. Price creates demand, demand creates price. This is how you get a melt-up. And here's the part people miss. By the time you see mainstream certainty, the easy part is over. So what are smart investors doing right now, inside this kind of setup? First, they're not panicking. Panic is what you do at the top. Strategy is what you do before the top. Second, they're separating paper exposure from physical reality. Because in a normal market, an ETF can feel like gold. In a severe crisis, people start caring about settlement risk, counterparty chains, delivery rules, liquidity gates, and the difference between exposure and possession. Not everyone needs physical metal, but everyone should understand why, in a real shock, the premium on physical can disconnect from the paper quote. The screen can say one thing while real-world availability says another. Third, they're watching oil like it's the early warning siren. In geopolitical stress, oil often moves first, then currencies react, then metals respond. If you want a leading indicator in this specific scenario, oil is the one. Fourth, they're not obsessed with catching the exact bottom tick or the exact top tick. That game destroys people. It turns investing into gambling. Smart positioning in a macro setup is about being early enough, not perfect enough. Fifth, they're staying informed beyond headlines. Because headlines are designed to spike your emotions, not organize your thinking. The market rewards people who can stay calm while everyone else is oscillating between euphoria and terror. Now, to be fair, we also have to talk about what could cool this move down. Because pretending metals only go up is how people get wrecked. There are real pressure valves. If a genuine diplomatic agreement materializes, verifiable, enforceable, not just a photo op, markets can exhale. Gold and silver can pull back from highs, not necessarily collapse, but correct. If the Federal Reserve hikes aggressively and real yields rise, the dollar can strengthen, and that historically can pressure gold. Interest rates are gravity for non-yielding assets. And if the world falls into a deep recession, industrial demand for silver could weaken. Gold might hold better in that case because it's more purely monetary, but silver can get hit on the industrial side. Those are real risks, but here is the key point. Those risks have to overcome a new baseline reality. A weakening trust backdrop for paper assets, central bank accumulation, industrial pull on silver, geopolitical instability that doesn't resolve in a weekend. That's why many observers say the path of least resistance is still higher over the next year or two, even with pullbacks along the way. Now let's talk about the psychological warfare inside this market, because if you don't understand that, you'll misread everything. When a market is being driven by fear and policy risk, volatility becomes a weapon. Not necessarily because someone is evil, but because the structure of the market turns volatility into a cleansing mechanism. You will see days where gold jumps hard and then gives back half the move. You will see days where silver feels unstoppable and then gets slapped down in hours. You will see calm followed by chaos, followed by calm again. That's not the story ending. That's the market testing conviction. The question you need to ask on those days is simple. Did the underlying drivers change? Did the geopolitical risk disappear? Did the debt suddenly vanish? Did inflation suddenly reverse? Did central banks stop buying? Did industry stop needing silver? If the answer is no, then the violent down day might be a shakeout, not a reversal. This is why the first 3 minutes of any serious analysis should not be about today's candle. It should be about the engine, because candles are the exhaust. The engine is the chain reaction we just mapped. Now let me put a sharper edge on the why this could get extreme argument. When gold starts from a much higher level, and when governments are running higher debt levels, the sensitivity of the system increases. Small shocks can create large responses because the system is already stressed. Think of it like a bridge. A new bridge can handle vibration. A cracked bridge collapses with the same vibration. We're in a more fragile monetary environment than most people want to admit. And fragility creates nonlinear moves. So what does that mean for gold and silver price behavior? It means you can see upside moves that look irrational. You can see corrections that feel cruel. And then you can see the market resume the trend because the macro engine is still running. Now here's a critical nuance. Gold and silver do not need a full-scale war to move higher. They only need the probability of escalation to remain elevated. Markets trade probabilities, not documentaries. If the probability stays high for months, capital will sit in defensive assets for months. That's enough to keep prices supported. And if the probability spikes higher abruptly, you can get a fast repricing event that forces everyone to chase. This is why people who wait for confirmation often buy at the highest emotional point. Because confirmation arrives when the crowd is already stampeding. So the real strategic question becomes, how do you act without letting fear hijack you? You build a plan. You decide what portion of your portfolio needs storm insurance. You decide what price levels or conditions would make you add, hold, or trim. You decide how much volatility you can tolerate without making irrational decisions. And then you follow the plan instead of the adrenaline. Because the people who win these moments are not the people with the loudest opinions. They're the people with the calmest execution. Now I want to ask you 2 questions, and I want you to answer them in the comments because your answers reveal how you're thinking about risk. First question. If oil spikes suddenly, do you think gold reacts first, or does the dollar react first? What's your sequence? Second question. Do you think silver will outperform gold in the next big move, or do you think gold stays the safer leader? Tell me why. Now let's bring it home with the big picture, because this is the part most people need to hear. Gold and silver are not just metals. They are a mirror of confidence. When the world feels stable, people chase growth. When the world feels unstable, people chase survival. We are in a period where stability feels thinner than it used to, and the market is reflecting that. The decisions being made right now in the capitals of the world are not just political theater, they are financial events. They change energy prices, they change inflation expectations, They change currency confidence. They change how people protect their wealth. And that ripple reaches ordinary people faster than they expect. So pay attention. Stay calm. Think in chains, not headlines. Watch oil. Watch real rates. Watch how the world reacts to risk, not what it claims to believe. And if you want more analysis like this, fast, direct, no time waste, hit subscribe. Short and simple. Subscribe so you don't miss the next update. Drop your predictions in the comments. Where do you see gold going next? 100 higher, 500 higher, or something bigger? And what's your silver number if this escalates? Because the next few weeks aren't just news. They could be the part of the cycle that people look back on and say, that was the turning point.